Hello, beautiful people, and welcome to this week's edition of the ITU Forex class. In this week's class, we're actually going to be talking about building a profitable Forex trading plan. Because you know what they say, right? If you fail to plan, you are only planning to fail. And a lot of traders, especially traders who are just kind of starting out with the whole trading thing, they don't take the time to craft a trading plan. They just trade based on whims and gut feelings and tips from, gurus and all of that. And then at the end of the day, they wonder why they don't make money. Or they wonder why they're, part of the losing majority of the Forex traders in the industry. And it's no surprise because a lot of the traders who do this for a living, they don't just wing it, okay, and just open the charts one day and just decide to go buy or sell any instrument they see or whatever. They have a strategic approach to the market. They take the time to create a profitable trading plan which dictates every single thing they are going to be doing in the markets. And that's why today we're going to be talking about how to build a profitable Forex trading plan to help you become that profitable trader you've always wanted to become. Okay? So without wasting any more of your precious time, let's dive right into it, okay? So why in the world do you need a trading plan? Why? Why can't you just, fund your trading account and just open the charts and just buy or sell at random? The reason is because for trading to work for you, you have to have an edge in the market. Okay? You have to have an edge in the market. And a lot of traders don't know what an edge is. So let me break it down for you. Most traders, when they hear you talk about an edge, they'll tell you that, yes, they do have an edge. They trade support and resistance, or they trade SMC, or they trade whatever. It's actually, an edge is not the strategy you use to trade. The strategy that you're using to trade is just part of what defines an edge. For you to have a complete package of a trading edge, that needs to contain your trading strategy, okay, which is one. Then number two, you need to also encompass risk management, which is two, okay? And then number three, you need, and this is the most important of them, because a lot of traders, actually, they think the strategy is the most important. It's not. It's the least important. It's important, but it's not as important as these other aspects. And the most important of them is actually trading psychology, okay? These three things you're seeing here, okay, they come together to give you what is known as an edge in the market. So what do I mean by an edge? Does this mean that if you have a good trading strategy with proper risk management and the right psychology, when you place a trade, you're going to have a 100% win rate always? Actually, that's not true. That's not what an edge is. Even if you have an edge in the market, or before we even talk about even if you have an edge in the market, what is an edge? What is an edge? An edge is just a probability of one thing happening over another. So to give you an example, when the market is in an uptrend, we know that markets, the financial markets, okay, price exists in one of three phases. It's either it is trending, whether uptrend or downtrend, or it is ranging in between levels of horizontal support and resistance, or price is consolidating, forming triangles, okay, because of low volatility. So these are the three phases that usually any financial instrument you're analyzing will exist in. Now, when we break it further, we'll realize that when the market is in an uptrend, it is in a trending phase, it's either it is in an uptrend or in a downtrend. If it is in an uptrend, it's going to be forming higher highs and higher lows, higher highs and higher lows. As long as that trend is remain healthy, price is going to keep forming higher highs and higher lows. It will keep breaking its resistance points and forming higher support levels. Okay? If price is in a downtrend, it's going to be forming lower lows and lower highs continuously as long as that trend remains healthy. Now, what does this have to do with an edge? Well, when the market is in a trending market environment, let's use the example of an uptrending market environment. The probability that price is going to continue going up, that is the probability, I need to go back to my slides. The probability that price is going to continue breaking above resistance and forming higher highs, breaking above resistance and forming higher lows, higher highs and higher lows, the probability that price is going to continue doing this is much higher than the probability that price will fall, just break below it and start forming lower lows and lower highs. Because as long as price maintains the structure of an uptrending market, which is the formation of higher highs and higher lows, then the probability of price moving to the upside is much, much higher than the probability of price suddenly moving down. So as a result of this, the idea is you want to build a trading strategy which will exploit the natural tendency of the market. So if you are trading with a trading strategy that is a trend following trading strategy, for example, when the market is trending up, you want to position yourself in such a way that you're going to be catching those up moves during uptrending markets. Because why is that so? The simple reason behind it is that if you position yourself to take advantage of buying opportunities during uptrending market conditions, you're already giving yourself an edge in the market, because the probability that price is going to continue moving high during an uptrending market is much higher than the probability that price is just going to suddenly start moving low during an uptrending market. Okay? And the opposite is for downtrending markets. When the price is in a downtrending market and it is forming lower lows and lower highs, the probability that price is going to, over time, continue forming lower lows and lower highs and keep moving down is much higher than the probability of price moving up very high, breaking above lower highs during downtrending market conditions. And so when you place trades in that direction of the prevalent trend, that trade is much more likely to work out as opposed to it hitting your stop loss. Now, does this mean that you're going to have a 100% win rate? For example, what I mean is, when the market is in an uptrend and you are trading in the direction of that trend, you are positioning yourself in the direction of that trend. Meaning, if the market is in an uptrend, you are buying, because the probability of price moving up is much higher than the probability of price moving down during an uptrending market. Does this mean that you're going to have a 100% win rate? Of course not. Of course not. And this is why, for your edge to be complete, apart from having a strategy which will tell you when to buy and when to sell and when to do all these things, you also need risk management along with that trading strategy, so that for the few times or the many times that you're going to be wrong, meaning you assume that price is going to go up but the market disagrees with you, okay? For those times, you want to lose as little money as possible. And so the other times when price agrees with you, you want to make as much money as you can, not as possible, because if you want to go for every single move that the market is going to give you, every single pip, you're going to expose yourself. That's greed. And you're most likely going to just keep leaving profits on the table. So you need to have a balance, okay? So if you couple these two, and then we'll talk about trading psychology, join them together with trading psychology, those three things are what is going to give you an edge in the market. Okay? So to make things easy for you to understand, let's assume that you're using a simple trading strategy, which is a trend following trading strategy. When the market is in an uptrend, you are going to be waiting for pullbacks in the trend. Okay? So when the market is forming higher highs and higher lows, you'll be waiting for the times that the market will retrace, and then you'll be buying at those pullbacks. And then when you buy, your stop loss is whatever you are risking, you're aiming to make 2 times that amount. So if you're consistently risking 1% of your trading account capital per trade, and you are aiming to make 2 times what you are risking per trade, just to keep it simple, you can aim to make, aim for a profit target of, which is 3 times or 4 times or even 10 times what you're risking per trade. But your win rate is much likely going to be lower the higher you go. The more profit you want to make per what you are risking, like if you're risking 1% and you want to make 10%, it's going to be harder for price to reach your profit target. It's not impossible, but your win rate is going to be affected, and so your win rate is going to be very low. So in this case, let's assume you're consistently risking 1% of your account capital per trade, and every time you're risking that 1%, you're aiming to make 2%, and you took 100 trades. So if you are using a trading strategy that is identifying buying opportunities for you in the market when the market is in an uptrend, and selling opportunities when the market is in a downtrend. Why? Because those are the things that are likely to happen during those market conditions. And let's say you're only right 50% of the time. So out of these 100 trades that you took, you will win 50 trades and you will lose 50 trades. But at the end of the day, all of the trades that you lost, you only lost 1% of what you were risking per trade. While for the trades that you won, you actually made a profit of 2%. So at the end of the day, your winning trades would have brought in a gross profit of 100%, and your losing trades would have caused you to incur a loss, which is minus 50%. So now your net profit is going to be, at the end of the day, with a 50% win rate, you're going to end up with a plus 50% profit. 50% profit. Even though the market only agreed with you 50% of the time, your win rate is only 50%. Now, we've talked about psychology and its relevance or importance in creating an edge or defining an edge. We've also talked about risk management and its importance in defining an edge, which will help you to create your trading plan, okay? Now, what about psychology? We've talked about strategy, we've talked about risk management. What about psychology? How does psychology affect all of this? Now, for you to understand the effects of psychology when it comes to building a trading edge, remember I told you this is like a three-legged table. If you have a table which stands on 3 legs and one of those legs is not in place, is it going to stand or is it going to fall? Obviously, it's going to fall because it's incomplete. It's not balanced. And this is what the idea I want you to have in your mind when you're looking at these 3 concepts, these 3 elements, components that we're talking about of creating an edge. So you can't build a trading edge without a good trading strategy. Even if you have proper risk management, if you don't have a good trading strategy and good psychology, it's not going to work out. You can't build a good trading edge with only a trading strategy and risk management without psychology, because it's not going to work out. So we've talked about strategy and risk management. How does psychology affect this? Now, let me just give you a simple example. You see, when I told you that you take 100 trades, in trading, there's something known as the law of large numbers. The law of large numbers, the idea with the law is that when you take trades, even if your trading strategy, let's say you've backtested the trading strategy and you've taken hundreds of trades with it, and from your backtest results, you've seen that your trading strategy has an average of, something like a 50% win rate. Even though this is an important number for you to know, because even with a 50% win rate, if you are doing proper risk management and you have a good risk to reward ratio, meaning whenever you risk, you don't risk more than 1% of your account capital per trade, you don't revenge trade, you don't get greedy, and you don't do all of those things, and you have a good risk to reward ratio, maybe whenever you're risking 1, you are trying to make 2. Even with a 40-something% win rate, you still end up being profitable if you take a large number of trades. And that is because of the law of large numbers. Most beginning traders think that when you give them a trading strategy, or when they research a trading strategy and find out that that trading strategy has a 50% win rate, they automatically assume that if they place 2 trades, because that trading strategy has a 50% win rate, one trade is going to definitely be a winning trade, and one trade is going to definitely be a losing trade. That's not how these things work in statistics. Even though, let me give you an example using a coin flip, okay? So even though we have a coin, for example, it has heads on one side, pardon my drawing, okay? So let's say it has heads on one side and tails on the other side. When you flip that, or let me put it this way, what's the probability of a heads landing or a tails landing when you flip a coin? What's the probability? It's 50-50. Because the probability, especially if that coin is an unweighted coin, the probability that the coin is either going to land on heads or tails is 50-50. Now, does this mean because the probability of the coin landing on either heads or tails, because the probability is 50-50, does it mean that if you flip the coin 10 times, it's definitely going to land 5 times on heads and 5 times on tails? Of course not. Of course not. Because that's not how probabilities work. You need to have a large sample size. And then after having that large sample size, then the real probability is going to approximately play out. So if you do something like 100 coin flips, okay, you're going to, more often than not, you're going to find out that approximately the coin would have landed maybe, 52% heads or 48% tails, or very close to that 50-50 mark. And this is kind of like the same thing which happens in trading. Even if you have a trading strategy that on paper you've backtested and you've proven that the edge of that trading strategy, it has a 50% win rate, okay, on paper. This does not mean that if you take 10 trades, 5 trades are going to definitely be winning trades and 5 trades are going to be losing trades. Or you're going to have one winning trade followed by one losing trade, followed by one winning trade, followed by one losing trade, followed by most times that is not how it's going to work out. Okay, most times you might have losing, okay, and then maybe winning and then losing, or you might even have winning, and then losing. Okay, it's random. The outcome of those trades is random. So again, this brings us back to our question: what does this have to do with anything? I'm glad you asked. What this has to do with anything is that this is the glue. I want you to think about this as being the glue which holds together your risk management and your trading strategy. Without it, you just keep struggling with trading. You cannot be a profitable trader. Why? It's because after you've backtested your trading strategy and you've proven to yourself that that trading strategy works, it has an edge in the market. Now you need to understand that because that trading strategy works does not mean that when you take a trade and it has a 50% win rate, this trade is going to be a winning trade and that trade is going to be a losing trade. And so where psychology comes in is that when you take a trade using your trading strategy which has been tested and it has proven that it has a 50% win rate, for example, you cannot expect it to give you winning and losing trades exactly how you expected it to be. Winning followed by a losing trade, followed by a winning trade. No. You can have a losing trade, followed by one winning trade, followed by losing trade. Most traders, when they start trading and they take one losing trade, 2 losing trades, 3 losing trades, a lot of them will just give up on the trading strategy. They will dump it and they will go and start looking for another trading strategy. Does this mean the strategy does not work? Of course not. If they were to have been patient with that trading strategy and keep taking the trades that the trading strategy signals, regardless of the outcome of the trades, when they take a large number of trades, like 100 trades, for example, at the end of the day, they would end up being profitable because the way their strategy is designed, even if they were to lose more trades than they win, if they keep their risk management in check, meaning they don't risk more than 1% per trade, and then whenever the trading strategy gives them a signal, they don't say, you know what, the last 5 trades that this trading strategy gave me were all losing trades, so I'm going to skip this trade, I'm not going to take it. No. Whether the last 5 trades or the last 10 trades were losing trades, whenever the strategy gives them a signal, they will take that signal without doubt. Because they know that at the end of the day, even if they were to take 100 trades, and out of those 100 trades, 60 of those trades were losing trades, and only 40 of them were winning trades, okay? If they were risking 1% of their account balance per trade, those 60 trades would have brought in a loss of minus 60% gross loss. While those 40 winning trades would have brought in, if you are aiming for a 1:2 risk reward ratio, meaning you are risking 1 to make 2. So those 40 winning trades would have brought in a profit of 40 times 2, which would be plus 80%. So at the end of the day, when you subtract your gross loss, which is minus 60%, from your gross profit, which is plus 80%, even though your win rate is only 40% in this example, meaning you took 100 trades and you only won 40 trades, you would still end up with a profit of plus 20%. So the professional traders know that they've already worked out their numbers. They've backtested their trading strategy and it has shown them that it has an edge in the market. They understand that for them to be able to be profitable, they need to stick with proper risk management. They can't just risk 1% and then after taking like 5 losing trades, they will get emotional and say, you know what, on those 5 losing trades, I lost 5%. I don't want to have to win, 2 or 3 trades to be able to recover the money that I lost or whatever. So I'm just going to, that 5% that I lost, I'm going to risk 5% on the trade I'm taking now, so that if that trade wins, I'm going to end up making 10%, meaning I would have made back the 5% I lost and I will make extra 5%. You understand? So they are essentially revenge trading because they can't accept that loss. If they do these little things, they will mess up with their risk management. They will mess up their psychology because they are not thinking like professionals. Professionals do not bother about the outcome of a single winning trade. They look at the outcome of or their trading performance after they take a large number of trades. like 100 trades, like I'm using in this example. So the day-to-day fluctuations in their account balance does not shake them. If the last 5 or 10 trades they take were all losing trades, they'll just simply look at their trading plan and say, you know what, I've already worked out the numbers, and out of these 100 trades that I'm taking, even if I was to lose 60 trades, if all I did was win 40 trades, I will still end up being profitable. So I'm not bothered. Even if, 10, 20, even 20 losing trades come in a row, it doesn't matter. And the trick is that the moment you accept this thought process, the moment you accept this, that's when your trading is going to change. Because when you accept that losses are part and parcel of trading, and you incorporate that acceptance into your risk management, so it becomes second nature for you to, whenever you're placing a trade, you are doing proper risk management. You're not gambling. You're not risking all of your account's capital or 50% of your account's capital on a single trade because you lost a couple of trades and you want to make back all of the money. You're not seeing signals from your trading strategy and doubting them because the last 5 trades or 10 trades you took were all losing trades. You are not doing any of that. When your trading strategy, which you've backtested and proven that it works, when it tells you to buy, you buy, regardless of whether the last 10 trades or the last 20 trades were all losing trades. And the trick is that when you start thinking like this, your trading is going to change, because if you are trading with a strategy that has a proven edge in the market, the odds of you taking 20 losing trades in a row is very, very, very little. Just like it's almost going to be impossible for you to take 20 winning trades in a row, it's almost going to be impossible for you to take 20 losing trades in a row. And we're not even talking about 20 winning or 20 losing trades in a row here. If you work out the numbers just like I showed you here, you are trading with a 1:2 risk to reward ratio, meaning whenever you risk 1, you are aiming to make 2. And then you've already set a goal that you are going to be taking 100 trades. So you are risking 1% of your account capital. So the only time that you're going to lose 100% of your account balance is when 100 trades that you take consecutively, all of those trades turn out to be losing trades. The probability of that happening is very, 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 very little. It's not impossible, but it's very, very low. And so when you accept thinking like this, that's when you see that trading is not stressful again. You know that after you take 100 trades, even if you lose more trades than you win, because of the way your strategy was designed and your risk management and all of those things, and the way you think about the market with your psychology, you're going to end up making money consistently. Okay? So I really want you to internalize this. For you to be able to build a profitable trading plan, you need to have an edge. And for you to have an edge, you need 3 elements, 3 components, which come together to help you, to give you an edge in the market. And those 3 components are your trading strategy, your risk management, and your trading psychology, just like I explained to you. Okay? So to do a quick recap, I need you this week, your action steps are to find a profitable trading strategy or create one. Creating one takes expertise, and that's why I would just recommend for you to find one on YouTube. There are lots of profitable trading. In fact, contrary to what a lot of traders believe, there are lots of profitable trading strategies out there. But the reason why a lot of traders, it doesn't work for them, is because when they find the trading strategy, most of them will not even backtest it to see the numbers behind the strategy. And for those who even take the time to backtest it, most of the times when they start trading with it live in the market, and they, like I gave you an example, when they encounter a losing streak, so maybe a losing trade followed by a losing trade, then maybe one winning trade and a losing. When they start seeing that they are making more losses than wins, most of them are just going to dump that trading strategy and start looking for the next trading strategy. Does this mean that the strategy doesn't work? Of course not. In fact, there are strategies that have a 35% win rate and still make a serious amount of profit. Why? Because whenever you're taking a trade, your risk is capped, and maybe your profit target is, you just let it run. And so for those type of trading strategies, it's not impossible for you to see one winning trade, which is very big, paying for a bunch of losing trades. But the problem is that most people are not going to be able to stick with it during the time when it's facing a losing streak. So it's not like the strategy doesn't work. It's that the psychology that people have, which is supposed to help them to, whenever they are taking those trades and they are taking those losing streaks and whatever, to just brush it off and just continue taking the trades, stick to the process. They don't even have that psychology, and so they will dump the strategy just as it is about to make a turnaround and give them good profits. Who is even talking about risk management? We're not even talking about risk management here, because in fact, when most traders, when they encounter those losing trades like this, they will start revenge trading. And for you to revenge trade, you need to do improper risk management, because revenge trading in essence is you taking a trade which is trying to recover what you lost from your losing trades, because you just can't accept those losses. Okay, so for you to build a profitable trading plan, you need to have these three things in place. And that's why I said the action steps for you this week is to find a trading strategy that is profitable. There are lots of them out there. Google it, search on YouTube. There are lots of profitable trading strategies. Then test that trading strategy in a backtesting environment using a simulator or whatever with proper risk management. And because it's a simulation, you don't have real money on the line. You're going to take trades and you're going to practice proper risk management. Most because when you practice proper risk management and there's no money on the line, when you encounter losses during your simulation, you're not going to be affected emotionally and trying to make all those revenge trades and all of that. So that will help you to really see the potential of the trading strategy. And so you'd end up executing it properly. But then after you've done all of these things, what is the goal? The goal is for you to have the mindset that professionals have, which is a mindset that they just trade like robots. When they see a signal, they take the signal. They don't doubt the signal or second guess its validity because they had a losing streak or, doing revenge trading or all of those trading errors that cause disaster for a lot of traders because of their emotions. Okay, they just see the signal, trade according to their plan, and that's it. And this pretty much brings us to the end of this week's edition of the ITU Forex class. But before we wrap up, you heard me talk about trading like a robot. And the reason why I'm making this statement is because robots don't have emotions. When you code them and you tell them if A and B and C happen, you should buy. Or if X, Y, Z happen, you should sell. And that's how trading is supposed to be. You're not supposed to have emotions and say, you know what, this trading strategy, even though it has a 50% win rate, since the last 5 trades I took were all losing trades, I don't believe the strategy again. I'm just going to find another one and dump it. A robot will follow through with the plan. And even if the last 5 or 10 trades were all losing trades, it's going to do what it's told to do. And because of that, the law of large numbers eventually is going to play in its favor. Because when it takes a large number of trades, because the risk management and everything has been coded well, it's going to eventually do proper risk management for you and make sure you're going to come out on top after taking those large number of trades. So in essence, we've got the portion of the company, apart from these ITU Forex classes, which are driven or designed to help you trade using manual trading techniques and improve as a trader. We also have a portion of the company which is designed to help you trade with automated trading strategies, automated trading bots, which are designed to take advantage of the markets and trade on your behalf to help you earn while you learn. Okay, so if you're interested in it, please reach out to us through the socials, reach out to us on the handles or in the comment section on all of that, and we'll be more than glad to assist you set everything up and get you up and running in no time. Okay, with proper risk management and everything, the bot is going to do each and everything for you. Follow our recommendations, and at the end of the day, you're going to be earning while you're learning, or even earning while you're asleep. Okay, while the bot manages risk properly for you, takes off the problem of trading psychology and thinking the last 10 trades were losing trades or whatever, so I'm not going to take this. The bot it has no emotions, and so it's going to trade the way it's supposed to trade. Okay, to trade for you professionally. So if you're interested, please reach out to us and we're going to be more than happy to assist you set everything up. Now, that said, I look forward to seeing you guys in next week's edition of the ITU Forex class. Once again, thank you and God bless you. Thank you. Enjoy the rest of your week. Cheers.